Even though the Russell 2000 and the Nasdaq are beating gold and silver, it's not by much. And I think risk adjusted, you're taking a lot more risk in those stocks. For my money, I'd rather just be in gold and silver than in the Nasdaq. And of course, the Nasdaq is going to collapse at some point, whereas gold and silver are still early in bull markets. And of course, as I've mentioned many times, I really like the miners. I mean, I like both. Everybody should be buying physical gold and silver. I was pounding the table again last week saying buy, buy, buy. And of course, this was a great week to have bought last week. For my money, if you want to be in the market, forget about these tech stocks. Yeah, they may keep going up, but they're going to come crashing down. So it's a game of musical chairs. And who knows if you're going to, have a chair when the music stops, which means you've sold. But with the gold and silver stocks, you don't have to worry about getting out because they're not in a bubble. You can hold these stocks for the long run because they're still super cheap in the short run.
Gold and silver are no longer just quiet safe haven assets. Peter Schiff argues they are still early in major bull markets, while the stock market, especially tech and Nasdaq, carries far more risk than investors realize. Peter Schiff, a noted economist and longtime critic of debt-driven markets, says that even though indexes like the Nasdaq and Russell 2000 have been strong, the real risk-adjusted opportunity may be in precious metals. He believes the Nasdaq will eventually collapse, while gold, silver, and mining stocks are undervalued and positioned for a longer move. Schiff notes that gold recently broke $4,700, while silver moved above $80, gaining over 9% in a week. Despite gains in GDX and GDXJ, he believes mining stocks remain cheap. While tech may rise briefly, he sees gold and silver as the stronger long-term play. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Everything was up pretty much this week except for oil and the dollar. Both fell. Oil fell a lot more than the dollar. Dollar just slipped a bit. But the news that was driving the markets, other than the continuation of the AI bubble, and I'll talk about that a bit too today, was the optimism of the war coming to an end. And we got a big rally earlier in the week when there was news from the president that the Iranians, were likely to accept some peace plan that we had offered, and that the war was ending and everything was going to open up and everything was going to be great, and we got a drop in oil prices and a rally in the market. Now, first of all, given the fact that the stock markets are at new record highs, save the Dow, right? I'll look at some of these numbers. So the Dow was up 0.6% on the week. It actually finished south of 50,000, but, still up 0.6% on the week. The S&P rose 2.5% on the week, hitting new record highs. Nasdaq up 4.5% on the week, new record highs. And the Russell 2000 up 1.8% on the week, new record highs for the Nasdaq. Obviously, the biggest drivers are the tech stocks, which are more heavily represented in the Nasdaq, and then also to a lesser degree the S&P than in the Dow or the Russell 2000. But the markets were very strong. I think the markets have already priced in victory, that we won the war, but not just that we won it, because obviously, if you're just going to count up the number of planes that were destroyed and ships that were sunk and people that were killed, right? If you're going to tally up all that stuff, right? Obviously, we were going to win the war if that's how you're keeping score, right? But the markets are looking beyond just the end of the war, but they're looking for a collapse in oil prices, a drop in bond yields, everything's back to normal, everything is great. And so I think the markets have already priced in the most optimistic of scenarios with respect to the war. So we're priced for perfection that we are not going to achieve. Who knows if the war is actually over? But even if it is over, we are not going to get the big drop in oil prices or bond yields that stock investors obviously think are coming. And in fact, oil did drop quite a bit, but it closed just below $95 a barrel. I mean, if the war is pretty much all over, we're still paying almost $100 a barrel for oil. Well, it wasn't just stocks that were up. Precious metals had a very good week. Gold rose 3.4%. We closed just over 4,700 in gold. Silver was the star, up 9.4%. Big move, double the Nasdaq on the week. Silver closed back above $80 an ounce. But it wasn't just precious metals. I mean, industrial metals. Look at copper. Copper hitting a new all-time record high. I think it closed about $6.24 a pound. Copper's another way to pay AI and not be in a bubble because, all this stuff needs copper, right? And so copper's going a lot higher. I mean, I think copper is going to trade where silver used to trade. Copper's going to be the new silver. So I'm very bullish on copper. In fact, year to date, copper's up over 30%. Think about that. 30%. Silver's up 11% year to date. That's not bad. Even with the big drop in March. Gold's up 9% so far this year. That actually beats the S&P, which is up 8%. The Dow's only up 2.5% so far this year. 4 months in, 2.5% up on the Dow. The Nasdaq is beating gold and silver, up 13%. Russell 2000 actually up 14%. Who'd have thunk it? Russell 2000 beating the Nasdaq. But even though the Russell 2000 and the Nasdaq are beating gold and silver, it's not by much. And I think risk adjusted, you're taking a lot more risk in those stocks. For my money, I'd rather just be in gold and silver than in the Nasdaq. And of course, the Nasdaq's going to collapse at some point, whereas gold and silver are still early in bull markets. And of course, as I've mentioned many times, I really like the miners. I mean, I like both. Everybody should be buying physical gold and silver. I was pounding the table again last week saying buy, buy, buy. And of course, this was a great week to have bought last week. But I would still encourage people to go to Schiff Gold and buy. In fact, now you can go to the App Store and download my app, the Schiff Gold app, and you can buy through the app. You can also set up a T-Gold account and buy your gold and silver there. I think we're going to have more up days ahead for gold and silver, but the mining stocks had good weeks. GDX up 8.8%, and the GDXJ up 9.5%. So the biggest winners on the week in the stock market as a group were the gold mining stocks. Year to date, though, gold and silver mining stocks are not up much. GDX only up 10.3%. That's barely more than the price of gold and less than the increase in the price of silver. And the GDXJ year to date is up just 11.2%. Barely more than the increase in silver. These stocks are still very cheap. And for my money, if you want to be in the market, forget about these tech stocks. Yeah, they may keep going up, but they're going to come crashing down. So it's a game of musical chairs. And who knows if you're going to, have a chair when the music stops, which means you've sold. But with the gold and silver stocks, you don't have to worry about getting out because they're not in a bubble. You can hold these stocks for the long run because they're still super cheap in the short run. So that's where you need to look. Look at these gold and silver stocks. Again, go to Europac.com website to check out the information on our funds, in particular the gold fund, the Euro Pacific Gold Fund.
The key warning is not just that markets are expensive. Schiff cautions that investors are misreading the signals. He believes markets are priced for perfection, assuming the best case outcomes on everything from geopolitics to yields, which he sees as unlikely. He argues that even if the war situation cools, oil and bond yields may not fall as stock investors expect. That matters because much of the market rally depends on the idea that everything is improving at once. Schiff sees that as dangerous optimism. At the same time, precious metals are already showing strength. Gold is outperforming parts of the stock market year to date. Silver is gaining momentum, and mining shares remain deeply undervalued relative to the metals themselves. Let's get back to the interview.
First, I want to talk about the jobs report. We get the jobs report typically the first Friday of every month. This time it's the second Friday because I think the first Friday was May 1st. And this is the 8th. But we got the April jobs numbers. And once again, we got a beat. Now, surprisingly, we didn't get much of a downward revision to the prior month. In fact, the prior month was actually revised up a bit from 178,000 to 185,000. But I think the month before that was revised down. So the net revisions were a negative, but not a big negative. But the expectation for the April jobs number was 63,000 jobs. That's a low bar. That's not a lot of jobs, especially for an economy the size of the United States. And we actually ended up creating 115,000 jobs. And the range of expectations was pretty large. It went from 0, unchanged, to 150,000. So, we came out, towards the upper end, not quite, but above, midway would have been like 75,000 jobs. So we were closer to the high end than the low end. But that is the story that's getting told. It's another beat. The numbers beat. This economy is strong. It's stronger than we thought. Look, more jobs than expected were created, even if we didn't expect a lot of jobs, because 115,000 jobs is nothing to brag about. This is not a good number. But of course, it's not even an honest number. The whole thing is a lie. You could take all these numbers with a grain of salt. They are all politically motivated. And remember, Trump fired somebody, I forget what her name was, when the numbers came out bad. Somebody lost their job. So there's a lot of pressure not to have bad numbers if you want to keep your job, right? I don't know why anybody pays attention to this stuff. But anyway, so let me look at the household survey. So according to the household survey, in April, the actual number of jobs declined by 226,000. So the establishment survey says we gained 115,000 jobs. That one gets all the headlines. But the other survey says we lost 226,000. No one really talks about that, but who's to say which one is right? I mean, my money would be on the household survey. Just, it just smells like a better number given what you observe. According to that survey, net jobs have now declined every month of 2026. Every single month. So all the positive jobs numbers are actually negative. And the average decline per month, this is not the total for the 4 months. The average number of jobs that have gone away in each month is 343,000 jobs. That is a huge number, according to the household survey. So according to that survey, we now have the fewest number of workers in America since December 2024. Think about that. That was, before Donald Trump, he became president in January 2025. So we've had no increase in jobs, in employment during the entirety of the Trump presidency, according to the household survey. Now, the establishment survey, looking at the supposed same labor market, according to that survey, the number of employed people is at a new all-time record high. So, how could that be? One of these surveys is wrong and one is right. My money is on the household survey because all of the publicity and all the political attention is on the establishment survey, which means that one is probably the wrong one. Also, what we learned from this survey is that in April, the number of full-time jobs collapsed by 424,000. Part-time jobs surged by 123,000. 123,000. So that is a big deal. And it's also a problem because full-time jobs pay a lot more than part-time jobs. They usually have benefits that part-time jobs don't have. And in fact, a lot of the people that have those part-time jobs may be looking for a full-time job, but they're not counted as unemployed anymore because they got a part-time job. So anyway, and the drop in full-time jobs, right, that we just got dragged the total number of full-time workers, again, to the lowest since December 2024. So no net full-time jobs have been created since Trump's been president. all of 2025 and 4 months of 2026, and not a single new full-time job has been created in supposedly the greatest economic boom in the history of the world. And according to Trump, before he was president, it was the worst economy ever. We were a dead economy. We were cold as ice. Now we're the hottest economy in the world. We're the envy of the world. It's the greatest economic turnaround in the history of the United States. Yet we haven't created any full-time jobs during this so-called boom. Obviously, this boom is in the imagination of Donald Trump. That's where it exists. It doesn't exist in reality. And again, Trump may not necessarily be imagining it. This is just Trump being Trump, because whatever Trump is trying to sell, whatever product he's got to sell is the greatest, is the best. And so when he's president, he's constantly trying to sell us on himself because he needs popularity. He needs, the poll numbers. And so he is constantly talking up the economy, exaggerating his successes, exaggerating the strength of the economy, just like he exaggerated, the greatness of Trump steaks or whatever else he was promoting when he was in the private sector. And I think the same delusion that we get in the economy, the same thing is going to happen with the war. It's going to be no different. And in fact, a lot of the peace talks that we've had this week, and now there's, peace plan that, has been submitted to the Iranians. We're waiting for them to get back, I guess. But there's a lot of optimism that's driving the market.
Peter Schiff's message is that the economy may be weaker than headline numbers suggest. He challenges the jobs data, noting that the establishment survey showed 115,000 jobs created, while the household survey showed a loss of 226,000. Full-time jobs dropped sharply, while part-time jobs increased, a sign of weakness beneath the surface. That is why Schiff believes investors should not be distracted by record stock prices or bullish economic headlines. In his view, the real story is a fragile economy, a risky tech-led market, and a precious metals sector that is still not fully priced for what may be coming next. His prediction is direct. The Nasdaq will eventually come crashing down. Gold and silver are still early in their bull markets. Copper is going much higher, and mining stocks could become some of the biggest winners as capital rotates away from overvalued sectors. For those tracking gold, silver, miners, and the economy, Schiff's message is clear. While the bubble looks strong, a safer long-term opportunity may already be shifting to hard assets. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.